Emerging Europe is one of the most underserved and overlooked areas for investment, but it's packed full of growth opportunities if you know where to look. While both the FTSE 100 and S&P 500 stole the headlines for record-breaking growth last year, it was in fact the MSCI Emerging Markets Europe that notched up the more eye-catching performance in the background. The index grew by 15.52% over a 12-month period to 18 January 2018. In other words, a £1,000 investment in an MSCI tracker fund would have grown to £1,155.20. This is higher than the 10.57% and 11.02% generated by the FTSE 100 and S&P 500 over the same period respectively. Yet the idea of investing in Russia, Poland, Hungary and other countries that fall under the Emerging Europe banner seems alien to not only the lay investor, but also active fund managers too. There are only 22 Financial Conduct Authority recognized actively managed funds that retail customers, the average investor, can access in this space. A fund manager running a global equity mandate, who wishes to remain anonymous, said he and many of his peers simply do not have the skills or expertise to cherry-pick emerging Europe stocks with conviction. Adrian Lowcock, investment director at asset manager Architas, said there was a lot of hype surrounding the sector in the past, particularly in the property market, but investors' appetite has since soured following the 2007-08 financial crisis. The global financial crisis highlighted the frailties of the emerging European economies, he said. Given their relatively small size, excluding Russia, they didn't have the political strength to combat the actions of the EU, US, Japan, and UK, quantitative easing, for example. Those which were members of the EU were of secondary importance to the likes of Greece, which is an emerging European country, but also in the euro. However, in the words of Bob Dylan, times they are changin', meaning here that there is cause for optimism over the future prospects for emerging Europe stocks. GDP growth in emerging European countries increased to about 3% in the first half of last year, up from 1.5% in 2016, according to the International Monetary Fund's latest Europe Economic Outlook report. This has been helped by a rebound from recession in Russia and a strong, policy-assisted pickup in activity in Turkey, following a dip related to the infamous failed coup d'etat attempt in 2016, the IMF said. It added that several economies under the Emerging Europe banner, particularly those that are EU members, are experiencing growth over 3%. Government spending has fueled expansion in these regions. The introduction of child subsidies in Poland has put the country on a good footing, while Romania has benefited from tax cuts to certain goods and commodities, according to the IMF. It added, in these economies, private consumption is expanding rapidly, as low unemployment and labor shortages have pushed up wages and boosted household confidence. Concurrently, investment has strengthened, partly due to the growing absorption of EU structural funds from low levels in 2016.
To put it colloquially, if Russia catches a cold, the other regions will sneeze. There is also a political angle here. A lot of the emerging Europe territories are heavily influenced by Russia, which means they are indirectly sensitive to movements in the price of oil, Lowcock said. It is also worth mentioning that emerging Europe has only recently experienced a spike in performance. Over the past 5 years to 18 January 2018, the MSCI Emerging Markets Europe Index grew by a miserable 1.67%, some way behind MSCI Emerging Markets Index, which gained 61.15% over the period, and the MSCI AC Europe Index, that rose by 46.25%. However, the tide appears to be turning. The MSCI Emerging Markets Europe Index is ahead over a 3-year period, returning 52.77%, compared to the MSCI Emerging Markets Index's gain of 49.61%, and the MSCI AC Europe Index, which climbed 41.63%. Lowcock said, as the global economy recovers, though we could see an improvement in the region, particularly as the rising oil price will benefit countries such as Russia. But, at present, it feels difficult to get excited about the region, and I wouldn't expect the level of interest and optimism to go back to levels seen before the financial crisis. There is, however, still growth in companies worth investing in the region, but stock pickers are essential, and I wouldn't suggest more than 2% in your portfolio. Claire Peck is the client portfolio manager of the JP Morgan Emerging Europe Equity Fund, which has returned 7.69% over the past 5 years, but has a better record over 60.29%. The portfolio targets long-term growth through investment in Central and Eastern European and Russian stocks that have previous form of growing their earnings sustainably, are under competent management and financially sound. She said, "We continue to find opportunities in high-quality, domestic growth stocks. We've added to real estate, which should benefit from rate cuts. Our energy and materials holdings are relatively high compared to history as we continue to see attractive valuations, superior dividend stories, and a better outlook for energy prices." Colin Croft, manager of the Jupiter Emerging European Opportunities Fund, selects stocks where ongoing changes in the outlook have yet to be reflected in the share price. The fund grew 16.40% over 5 years and 71.77% over 3.He said Russian equities have scope to play catch-up this year, after lagging despite significant gains in the oil price during 2017. What's more, the possibility of further U.S. sanctions that might result from a probe into allegations that President Donald Trump worked with Russia on the election has already been priced into Russian shares, Croft added. He said, while sanctions can be effective against small, open economies that are dependent on external financing, it is, in my opinion, unlikely that they will have too much of an effect on Russia, as it is a large economy with a high degree of self-sufficiency and self-financing. Russia has a current account surplus of over 2%, a budget deficit of just 2.1%, and its budget is based on a price of $45 per barrel of oil, while the current price is more than $65. Even if the U.S. were to go for the nuclear option of forbidding Western investors from buying sovereign debt, the Russian economy would not come to a standstill and would still be able to fund itself from internal sources, albeit at a slightly higher cost. Consequently, I see scope for the market to react positively, and by the fact once the extent of sanctions becomes known and the uncertainty removed. Croft favors Lukoil, the largest oil company in Russia, which has recently announced it will cancel up to 14% of the shares it currently has in treasury and buy back even more of its shares. A hugely positive signal, he said. Interestingly, both managers back Sberbank, a state-controlled Russian banking and financial services company. The stock is the largest holding of the JP Morgan fund. Tech rates the bank's prospects for the future because of its unique stronghold on market share in Russia and credibility of its management. Meanwhile, Croft said the stock could almost double earnings and dividends over the next 4 to 5 years. Handpicking the best stocks is not the easiest thing to do at the best of times, but it's all the more difficult when dipping into a basket of shares in an under-researched region such as emerging Europe. This is something that is often best left to the professionals and their research resources. We asked Lowcock to select 4 funds that could fit the bill. He picks both the JPM Emerging Europe and Jupiter Emerging Europe, which charge ongoing charges, OCF, of 0.93% and 1.26% respectively. Lowcock also favors Invesco Perpetual Emerging Europe, which is managed by Nicholas Mason and returned 37.31% over the past 5 years. It levies an OCF of 1.17%. Fidelity Emerging Europe, Middle East and Africa also makes the cut.
The fund invests in less developed countries of Central, Eastern and Southern Europe, including Russia, the Middle East and Africa, including countries that are considered emerging markets, according to the MSCI Emerging Markets Europe, Middle East and Africa Index. It is managed by Nick Price and Greg Constantinidis, and has returned 47.05% over 5 years.